All right, so it's month end and you estimate your utilities. You record the expense and everything looks clean. Then the bill arrives and it doesn't match. Not because you made a mistake, but because you didn't have all the information yet. Here's the first thing to understand. You are not estimating the full bill. You are only estimating the portion of usage that hasn't been billed yet. So let's walk through a real example. Your last utility bill covered the time frame from May the 1st to May the 20th. Now it's May the 31st. So you need to estimate usage for May the 21st to May the 31st, and that's 10 days of unbilled usage. At month end, you estimate a daily rate. Let's say the estimated rate is $4.50 per day. So your accrual becomes 10 days times the $4.50 per day, or $45. For your adjusting entry, you debit your utilities expense for $45 and you credit your accrued utilities for the same. So now the actual bill arrives and it covers May 21st to June the 20th. The total bill is $150 and it's over 30 days. Now we calculate the actual daily rate, which is 150 divided by 30 days, or $5 per day. Now we focus only on the portion that belongs to May. That's still the 10 days, May 21st to May 31st. So the actual amount for May is 10 times the $5 actual daily rate, which is $50. Now we compare our estimated, which was $45, to the actual, which is $50, and the difference is $5. So the actual usage was actually more than what our estimated amount was, but not by much. The journal entry that we need to use is we need to increase the utility expense by $5, and we need to credit our accrued utilities for the same $5. Now, if your utilities expense and the difference between your actual and your estimated was actually higher than your actual, then this journal entry would be in reverse. So you would debit your accrued utilities, which is a decrease, and you would also, you would debit your accrued utilities, which is a decrease, and you would credit your utilities expense, which is a decrease, recognizing that you subtracted too much value from your revenue or your income in the first case, and you're just making that adjustment. So now the bill gets paid. $150 leaves your bank account, but there are actually two correct ways to handle this in a system. In scenario one, we have a direct clearing system. It's a simpler system. In the simpler system, you clear everything directly. So you already know $50 relates to May, that's accrued and adjusted, and $100 relates to June, that's the new expense. So you record the debit to accrued utilities of $50 and the debit to utilities expense for $100 and credit cash for $150. This clears the liability from May. It recognizes June usage, and it reflects the full cash payment. For scenario two, we have a two-step clearing or more structured system. In a more structured system, you separate the bill recognition from the payment. So step one is when the bill is received, you move the accrual into accounts payable. So you debit your accrued utilities, that clears out the $50 first. You debit your utilities expense, which is $100, and you credit the accounts payable utilities for the full $150. Now the accrual is cleared and the full obligation is formally recognized. Step two, when the payment is made, now you simply clear the payable. You debit your accounts payable, utilities for $150, and you credit cash for the other $150. Both approaches are correct. The difference is structure. The first combines everything into one step. And really, it's about, did the payment happen at that time? Because if the payment happened at that time, then there's no reason to move the utilities expense into a payable, and then the payable gets debited when cash gets credited. It just combines everything, but only if the payment is made on that day. The second separates recognition of the obligation and settlement of the obligation. And while the first one may seem simpler, the second one is more accurate, because if you don't make the payment on that day and you make it sometime in the future, let's say by the time that the payment is due, then you know that it's all in the account payable, and you just have to make sure that you're monitoring the accounts payable rather than making the payment at the time that the bill arrives. Now let's zoom out. For May, the expense was $50. It's fully reconciled. There's no remaining liability. For June, the expense begins with $100. We'll continue to accumulate based on usage, and we repeat that process by estimating what that usage will be and then comparing it when the next bill arrives to what it actually was. So this is the core idea. You are not reconciling the bill. You are reconciling the portion of the bill that belongs to the prior period. Everything else belongs to the current period. So here's the complete utility bill process flow diagram. Firstly, we estimate the usage that's attributable to the period between the last bill date and month end. Secondly, we accrue to represent the expense and the accrued utility. Third, we receive the bill. Fourth, we recalculate the actual amount versus the estimated amount. 5, we make the adjustment. 6, we allocate. And 7, we make the payment. So now you've reconciled cash through bank reconciliation, accruals, and partial period estimates. Next, we move into something more complex, which is credit card reconciliation, where you have multiple transactions, interest, and timing differences, and they all interact at once. You estimated the portion, you measured the reality, and you adjusted the difference exactly where it belonged.